The future of America is expensive, and the government is looking to you to pay for it. The federal government levies a death tax, which is a 40% tax on value above a certain threshold. Now, at the moment, that threshold sits at right around $11.7 million, so high that 99.9% of estates are unaffected. But the IRS is now looking to pay for $3.5 trillion in domestic programs by the end of 2021. Lowering the estate tax threshold and expanding the death tax is one way they plan on accomplishing this. Now, if this sounds crazy to you, keep in mind that threshold was as low as $1 million as recently as 2002. The death tax must be paid within 9 months of the date of death, so oftentimes heirs are forced to panic sell assets belonging to the deceased in a fire sale to pay the tax. Now keep in mind, we're just talking federal estate taxes for the purposes of this video. Many states have their own state estate taxes that would be levied in addition to the federal death tax. So in this environment, it would be wise to assume you will have an estate tax problem and address it rather than pretend it will go away. There are exactly 3 ways to address your estate tax problem. Number 1, give your assets away. There are many gifting strategies to move assets out of your taxable estate and into the hands of outside parties. Family, friends, a favorite university, charities, and foundations, for example. Number 2, spend it. You've got money to burn, so get to burning it. Buying cars, cruises, and other depreciating and value-wasting items is one way to minimize your estate and reduce any future estate taxes you'll owe. Number 3, insure it. Rather than spending money like crazy or just giving all of your hard-earned assets away, you can utilize a life insurance policy that will pay out enough to take care of that tax bill upon your death. This strategy turns pennies into dollars and lets a life insurance company pay your estate tax bill for you. Many people don't know that life insurance is by itself subject to the death tax. That means that if you have a $1 million policy and a taxable estate, your beneficiaries could owe $400,000 from that policy back to the government in estate tax. So, to take proper and full advantage of this life insurance strategy, the insurance policy must be set up in a way that does not include the policy in your estate. This is where an Irrevocable Life Insurance Trust, or ILIT, comes into play. An ILIT sets up a trust outside of your estate that will own, pay for, and be the beneficiary of a life insurance policy on your life. Now, an ILIT is not simple to set up, and you will need the help of a skilled estate planning attorney to execute this strategy. But when executed properly, an ILIT can save your loved ones and heirs millions of dollars in death taxes and ensure that the legacy you've worked so hard to build is passed on in the most efficient, cost-effective manner possible.